Stuart Thomson helps manage £70 billion as a portfolio manager at Ignis Asset Management. He joins us now from Edinburgh. Stuart, you stay long core, short periphery, with a bit of gilt thrown in there as well?
Yes, it's the safe havens that we believe investors should be focused on. There is an acute shortage of safe havens in a very unstable world.
Is gold a safe haven?
No, it's not. We believe that it is the government bonds of the UK, of Germany and the United States that are the true safe havens.
Why is the Bund a safe haven, given the fact that Germany may end up shouldering considerable risk here? You could see a sharp repricing of the German maturities.
That would be the case if Germany was willing to extend its balance sheet to the rest of Europe. The problem with that is that there is no constitutional means to do so. So it will take many years before that becomes a reality.
If we get a very crunchy weekend and we get bank runs and we start to see significant problems, the Bundesbank is going to be heavily exposed via Target 2. In that kind of scenario, do you think the Germans would put their neck on the line? Because it has implications for the Bund market.
I think at this stage what we would see is another LTRO, the ECB extending more liquidity, just basically trying to buy time for the politicians to reach an agreement, but that agreement is far off.
How low will yields go on the German 10-year then?
We believe they will go below 1%.
Below 1%. This isn't Japanese-style deflation here we're talking about. This is a safe haven trade. This is, I want my money back. It's about the return of your cash rather than the return on your cash.
Yes, and there is similarities to Japan. It was Robert Feldman, Morgan Stanley, who coined the phrase crisis response improvement complacency. We have moved from the complacency of LTRO into a new crisis. There will be a response, but they will buy time, so there will be further crises to come.
How do you think the core peripheral spread would react to another round of LTRO? We're talking here about the central bank flooding the market again with liquidity.
Well, I think you'd get the law of diminishing marginal returns, so you get an improvement, but the improvement would last less than the previous two LTROs, but clearly positioning would be enough to produce a short squeeze on these markets.
If they don't do LTRO, and I appreciate your argument about the sort of bang for your buck and the diminishing gains of that, do you think they might buy other asset classes? We've seen the central banks, well, the ECB buy covered bonds, the Fed. There's been a lot of chat about sort of mortgages and how that market works. PIMCO is certainly positioned for that. Should we be looking at other asset classes and potentially a bigger bang for your buck for the central banks, and investors need to position for that?
We could look at other asset classes, but as Mervyn King says very clearly, that is not monetary policy, it is fiscal policy. And for the ECB to intrude into the realms of fiscal policy would be beyond its remit. So we would have to see either a change in its remit or governments backstopping that.
This weekend's G8, anything substantial coming out of it? Merkel could look quite isolated, but aside from that, is it really going to generate anything?
Well, unity and cooperation are fair weather friends, and these are very stormy times. I think we'll see a lot of recrimination, the rest of the world telling Europe to put its house in order, Europe and America asking the developing economies to try and do more stimulus. These economies are slowing down. I think that's the most important trend that we're seeing lately, has been the slowdown in emerging markets. They're suffering from growth recessions as well as the US and the UK.
The US data has been getting a little bit more soggy. Is that a trend that we can extrapolate? Do you think that the US economy is slowing down? Because that will bring forward policy action, particularly in an election year from the Fed. The window of opportunity for the Fed to take action is going to close fairly soon because November is coming and the elections are coming, and that means that they can't be seen to sort of get involved in that election, so they don't have much time left.
Yes, we think the underlying growth rate in the US economy has improved over the last year, but it's around 2%. That's below productive potential. It was higher in the first quarter due to faulty seasonal adjustment and the good weather. We're seeing the reversal of that good weather impact, so growth is slowing down to around 1.5% temporarily over the next couple of quarters. The Fed, we believe, will extend Operation Twist. That has been one of the most effective policies over the last year. we don't believe there will be, the economy will be weak enough to justify full-blown quantitative easing.
Stuart, we'll leave it there. Thank you for the time. Thank you for your investment advice. Stuart Thomson, Chief Market Economist at Ignis Asset Management.